Hi, my name is Drew Blazik. I want to thank you for watching this video on option strategies. If you could, I would really appreciate if you could like or share this video. I put a lot of time into these Excel sheets, which I try to make very user-friendly, where it's easy to learn, and I give it for free. So if you could, like and share, let's get into the model. In this new option strategy, we're going to look at a protective put. We're going to look at, we've already talked about that we can use put or call options. And now what we're going to do is look at the different strategies as using multiple, not just to use it by itself. And in this example, we're looking at a protective put, is where you're buying the underlying asset and plus you're going to buy the put, an option to sell. You have the right to sell at a certain point. So let's get into the model. So like all my videos, look just below. I got the Excel sheet and you could just work with my Excel sheet and see how we're going to do it. So let's look, before we start entering our values, let's look what it is. The strategy is neutral to slightly bullish on the underlying asset, but is looking for a downside protection. So we believe that the asset's going high. That's what we're going to look for. We're bullish on this regard, but we want protection that if it did fall, I'm going to be protected. The construction of it is that we're going to buy the underlying asset and then we're going to buy at the money or out of the money put. The upside is unlimited. We can make depending on how much the stock goes up, there's no cap to our upside. And then the downside, it's limited because we're going to be protected with the put. So let's go into our model and we'll start plugging in our values. Okay, just like I've done before, you could put any stock price that you want. I'm going to put $100. And then what we want to do here is we want to look at the different price range that our stock can go plus or minus. The next step is putting an incremental amount. I want this to go by 5%. Now, if you want a larger range to see different prices, you could do 10%. But what I'm going to do is enter 5. And what it's going to do is continuous compounding. It's going to decline by 5% incrementals up until 30%. And then it's going to increase by incremental to 30% positive. So we have these different stock prices. So like I mentioned before in my previous videos, if we long the stock, it means I'm purchasing the stock. If we long the put, I'm purchasing the put. And that's what we're going to do with both of these. We're going to buy the stock and buy the put. So when I buy the stock, let's think this through. What is our profit loss? Well, the stock price is 100. So let's say the spot price just means today. So I'm going to say my profit loss is going to be the stock price of the range. If it goes down, I'm going to lose money. If it goes up, I'm going to make money. And what I'm going to do is I'm going to subtract out the stock price up there, what I purchased it for. And what I'm going to do is hit function F4 because I want to make that absolute. When I drag all those different stock prices, I don't want the original price to change. So as you can see, if I buy for 100 and the price is 100, I made a 0 profit. Now let's go down. So what I'm going to do on my control pad, my keyboard, is I'm going to hold down shift. I've already did the equation. And then I'm going to hit control D. That's control down. So if the stock goes up, our profit loss in the stock is it goes to 135 minus 100. Therefore, we made 35 on the stock. And then if it goes down, now what I'm going to do is I'm going to grab that bottom right corner and I'm going to drag that up. And if the stock goes down, we can lose. So this is the downside of losing if the stock goes down. Our downside, you can lose everything on it. The upside, it could be unlimited. So how do you make a protective put? Well, we're going to make a protective put by buying the put and buying the stock. So what I'm going to do is I'm going to show you an example of what it's going to look like if it's in the money. I have a right to sell and then I'm going to drag that down to do the rest. All right, first thing I want to do is put a stock price or a strike price on there. So we're going to say we have a, excuse me, I have a right to sell for $95. I'm going to hit tab. And then we got to say, what is the premium? What is the cost of the contract? Well, the contract I'll put down is $10. And remember, that's a right to sell. I'm not buying it if you buy a put, but I'm buying the contract, but not the asset. But in a protected put, I did buy the asset on itself. So let's put the equation here. So what we're going to do is we're going to buy the put. So right away, if we're going to buy it, it's going to cost us something. So I'm going to say minus the premium, right? I'm going to hit function F4. I want to freeze the premium. And then I'm going to say plus. And if you remember from my previous video, anytime we purchase a option contract, that's going to be a max function. It's a minimum if we sell it. So we're going to purchase it. And now you want to think about what's your profit loss on a put. So if the stock goes down, I have a right to sell it for 95. That means it's going to be the strike price, function F4, we're going to freeze that. And that's going to be minus the stock price, the current stock price. So if I get to sell it for 95 and the current stock price is say 74, I make that difference. That's the benefit of the put. And then what we did here, and you want to kind of think it through, if we're purchasing the contract, I'm going to exercise the put if it's in the money, right? If it's in the money. So the stock price is in the money because it is below the strike price at that point. If it's below the strike price, I'm going to exercise it. So I want whatever's maximum between my profits of the strike minus the stock and 0. So for example, if this becomes negative, which it will down here, I want it to say 0 because I'm not going to exercise the contract. I'm going to walk away and all I'll be down is the premium. So I'm going to hit enter. And to see if you did it right, sorry, went too far down. I'm going to hold down shift. I'm going to scroll all the way down to those values, hit control D, fill in the rest. And that's our profit loss on the put. The most we can lose, because we will not exercise it if we're out of the money, is $10. And then as we go down, we can make the difference between the strike and the stock and minus the 10 for the premium. All right, next what we want to do is what is the protect to put strategy? So I'm going to say equals how much are we making? And all you're going to take is the profit loss on the stock plus the profit loss on the put contract. And we're going to add that up. And then as I go down here, that's going to give our put strategy, and that's going to fill out our graph here. All right, so before we do the graph, I'm going to go a little more in depth, a little more analysis on the graph before we get to that point. I want to know what is the difference between how much does the strategy protect me? What is the difference between the protect to put strategy and just owning the stock by itself, right? We're buying the put to protect myself from downside. So let's just look at the difference here. It's going to be the put strategy minus the stock. If we just bought the stock by itself, I want to know the difference of how much are we up or down on that. And as you see, if the stock loses money, that's where I am up in value. If the stock goes up in value, I'm always negative $10 because I will not exercise it. So if the stock goes up to, right now we have $100 and then 135, 150, I'm just going to walk away from the contract. I'm not going to exercise the put. So my strategy would be negative 10 than what I would have been if I just owned the stock by itself. So let's go over to the graph. This is the protect to put graph. And what's nice about this graph, it's interactive, as in I'm going to hit the filter button. And what I'm going to do is I'm going to highlight, I'm going to select all those, but not the comparison. I'm going to hit apply. And let's kind of go through these different lines here. So the orange line is the put. The orange is the put. The blue line is the profit loss for the stock. And then if we combine the profit loss of the stock and the put, we have the protect the put, which is the green. And as you can see, and I like to show this comparison, that's the stock, right? This is the put. We're always negative $10. We're $10 down from doing that strategy as of what we would have been if we just bought the stock. However, the stock can lose all of its value. Now, I don't have it scaled all the way to zero, the x-axis, but if you lose, it goes bankrupt, you lose it all, but you are capped for how much you can lose on the protect the put. So again, I'm going to go to filter, I'm going to highlight those, and I'm just going to hit the strategy there, apply it, and I'm going to go back to that graph. Well, there you go. That's the lesson, the lecture on a protect the put. Hey, save this Excel file. You have the information there, how to solve it, the graphs, and see the strategy and the benefit of using this option strategy, right? I'm bullish. I believe the market might go up, but I want downside protection because it's very volatile right now in the market. And that's what a protective put gives you. And the last thing I want to talk about in this video is what does that look like, right? So you see that protective put, and I don't have it up on the screen right now, but I just want to kind of talk about it. A protective put is identical in it. Now, if it's the same underlying asset and the same strike price as owning, so a protective put, owning the stock, and the put is equal to buying the call contract, because it looks like a call contract, and holding on to the money that I would have bought the stock and waiting to see what happens. That's called the put call parity. So the protective put is equal to buy the stock, buy the put is equal to holding on to my cash, and I'm going to discount it by the risk-free rate, and I'm going to buy the call contract to see what happens. There you go. I want to hopefully you found value in this lesson. Let me know in the comments what you think, and the next video on the playlist will be a covered call.